Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Today, guys, we're going to look at what we call a production budget. At the end of this lesson, you should be able to prepare a production budget for a 3-month period. Now, we're going to look at what is a production budget. Now, production budget is basically a forecast of the units of products that must be manufactured based on information from the sales budget and taking account of planned amount of finished goods inventory to have on hand, usually a safety stock to cover unexpected increases in demand. So remember, it is a forecast. You're planning for the units of products that must be manufactured. But you also take into consideration the sales budget, as well as the finished goods that you want to have on hand at the end of the period. Now we're going to look at the format in preparing a production budget. And it is very simple. And I say simple, yes, it is simple. I know I've used this term a lot, but guess what? It is relatively simple, okay? So the first thing that you would pick up is the expected sales, and this will be coming from your sales budget. I've done sales budgeting in a previous lesson. The link will be in the description below for you. So you pick up your expected sales for the period, then you add your desired ending inventory. Once you add your desired inventory to your expected sales, that give you your total production that is required. So it will tell you how much units you need to produce for that period. Once you have that, you're going to subtract your opening inventory, which is your beginning inventory. And guess what? This will give you the products to be manufactured, the total products to be manufactured for the period. So remember, your expected sales. How much products are you expecting to sell for the period? Add your desired ending inventory to that. That will give you your total production that is required. And remember, your desired ending inventory is like your safety stock. You're having this in hand just in case your demand increases. Okay? Once you have the expected sales plus the desired inventory, remember that gives you your total production that is required. And from this, you're going to minus your beginning inventory. And that will give you your total products to be manufactured for the period. Now we're going to use this knowledge to complete this question that is taken from the Collins CAPE Revision Guide, that Collins Accounting Revision Guide. Forbes Company projected sales for the next 4 months are as follows. And you're presented with sales for July, August, September, and October. Bear in mind that this information will be coming from the sales budget. If you have missed that lesson on sales budget, remember the link is in the description below. Additional information, and you need to pay close attention to this detail that is provided. 1, the end of the month inventories of finished goods must be equal to 10% of the next month's sales. What are we basically saying? For July, the ending inventory should be 10% of August sale. So that would be 10% of 45,000, which would give us 4,500. Note 2, the ending inventory at the end of June was 3,000 units. And this information is very important because this stands as your opening inventory for July. Now, bear in mind that closing inventory for one period becomes the opening inventory for the next period. So closing in the inventory for the last month becomes the opening inventory for the current month. You're required to prepare a production budget for the first 3 months, showing the number of units to be produced each month and for the 3 months in total. So let us look at our workings for that. Let's prepare the production budget. So your heading is Forbes Company production budget for the 3 months ending September. And we have July, August, September, and there's a column for total because yes, we were asked for the total. So the first thing that we begin with, remember from that very short format, the first thing that you would enter is your expected sales. And coming from the question, expected sales for July is 30,000. For August, it is 45,000. For September, that is 60,000. And for the total, we're going to add all of these expected sales, and that gives us a total of $135,000. Once you have entered the expected sales, your next step is to add desired ending inventory. Now, what is the amount that they want to have on hand at the end of each month or period? Now, from the question, note 1 gave us that instruction, and it indicated that we are to allocate 10% of the next month's sales as ending inventory. So for July that we are in, we're going to find 10% of the next month, which is August sales, and that would be the ending inventory. So remember that is 10% of the 45,000, and that will give us 4,500. For August, it is 10% of the next month, which is September sale, and that is $6,000. And for September, it is 10% of October's sale, and that is 10% of 50,000. So that gave us $5,000. The total desired ending inventory would be the 4,500 plus 6,000 plus 5,000, and that gives us a total of $15,500. What we're going to do now is to do our computation for each month, and that is going to give us what we call total production required. And we're going to do it for each month. For July, we have a total of 34,500. August, when we had this 6,000 to the 45,000, we get $51,000. For September, that is 60,000 plus 5, so that is 65,000. And our total would be 34,500 plus 51,000 plus 65,000. And that would give us 150,500. Apart from that, if you add the total expected sales and the total desired ending inventory, you should get back this $150,500. Our next step is to less the beginning inventories. That is our opening inventory that we are subtracting now. Remember, the closing inventory for one period becomes the opening inventory for the next period. The closing inventory for the previous month, which would have been June, is presented in note 2, and that is 3,000. So it means that for July, that 3,000 becomes the opening inventory. So we're going to subtract that. For August, the opening inventory is coming from the closing inventory from July, which is 4,500. For September, the closing inventory for August was 6,000. So it now becomes the opening inventory for September. And now we're going to put in our total. Our total is 3,000 plus 4,500 plus 6,000. And that gives us a total of $13,500. And we're now on to the final stage where we're going to generate the products to be manufactured. And here we go with our calculation. Total production required, less beginning inventory for July. leave us with 31,500. For August, it is 51,000 minus 4,500, and that gives us $46,500. For September, that is 65,000 minus 6,000, that is 59,000 as the products to be manufactured for September. And the total products to be manufactured for that quarter, which is for the 3 months ending September, is the 150,500 minus 13,500, and that gives us $137,000. Apart from that, people, if you add the products to be manufactured for the 3 months, which are July, which is 31,500, August, which is 46,500, for September, which is 59. If you add all those figures together, you get the total products to be manufactured for that quarter of 137,000. And that is basically what is required of you when you prepare the production budget. So let us look at the summary of this in details. So remember, for July is 31,500. For August, it is 46,500. For September, that is 59,000. And the total for the period is 137,000. So on the journey for that business, the first month units to be produced is a total of 31,500. For August, that is 46,500. September, that's 59,000. And when you add up everything together for the quarter on the journey, what the business needs to produce is a total of 137,000 units. And that takes us to the end of this lesson, where we looked at preparing a production budget for a 3-month period. In our next lesson, we're going to look at a past paper, and we're going to look at how the production budget relates to the purchases budget. And you'll find that it's pretty much the same concept that will be used.
Like, share, and don't forget to subscribe.